In previous episodes, we examined what happened to MMTLP. A publicly traded security was halted, converted into private shares, and never resumed trading. Investors didn't lose ownership, they lost liquidity. Episode 5 asks a different question. Who had the power to stop this, and why didn't they? Financial markets don't operate through a single authority. They function through a chain of responsibility. Each link has a defined role, each link has limits, and each depends on the others to act. To understand what happened with MMTLP, we need to examine how that chain works. At the center of U.S. market oversight is the SEC, the Securities and Exchange Commission. The SEC sets rules, enforces securities laws, and oversees self-regulatory organizations. One of those organizations is FINRA, the Financial Industry Regulatory Authority. FINRA has authority to halt trading, including the rarely used U3 halt, intended for extraordinary circumstances. Exchanges execute trades. Brokerages provide investor access. Issuers carry out corporate actions. No single entity controls everything, but each controls something critical. A U3 halt is designed to pause trading when extraordinary events create uncertainty. It is meant to be temporary. It is meant to protect market integrity. And in most cases, trading resumes once clarity is restored. U3 halts are rare. Permanent outcomes are even rarer, which makes what happened next highly unusual. MMTLP was halted just days before its scheduled corporate action. Trading did not resume. There was no final trading window, no reopening auction, no price discovery. Instead, the security transitioned directly from a public market instrument into private company shares. The shares still existed, but the market mechanism did not. What investors expected was straightforward, an orderly conclusion, a final opportunity to trade, a transparent process. What occurred was different: a halt, a conversion, and no public market, no quoted price, no brokerage sell function, no immediate path to liquidity. Here's where the questions emerge. FINRA had halt authority, the SEC had oversight authority, brokerages executed instructions, exchanges followed regulatory direction. But at no point was there a publicly communicated plan for how investors could exit. The system functioned, but without a release valve. A structure built for transparency produced confusion instead. MMTLP is not just about one ticker. It raises a broader question. If a public security can be halted, converted, and closed without a resumption of trading, what protections truly exist for retail investors during extraordinary events? In the next episode, we'll examine what happened after the halt, the legal challenges, the investor response, and whether accountability is still possible, because the halt may be over, but the questions are not.